4 ways to save to beat inflation. Are you worried about how to save money and preserve your wealth in the face of inflation? Inflation is like the silent enemy of your money. It can erode your savings and make it difficult to achieve your financial goals. However, there are effective ways to protect your money from inflation and keep your wealth safe. Why we need to saving money is the foundation of financial freedom. Without savings, it will be challenging to reach your financial goals, whether it's buying a house, starting a business, or retiring comfortably. But simply saving is not enough. We also need to protect our savings from inflation, which can reduce the value of our money over time. In this video, I will share a parable that explores 4 ways to save to beat inflation, supported by statistical data. The Investment Quartet, a tale of savings and gains. Once upon a time, there were 4 friends, Jack, Jill, John, and Jane, each with $10,000 in savings and the desire to protect their money from inflation. Each had a different strategy. Jack suggested putting all his money in a savings account that pays 2% interest. Jill decided to buy gold, historically a solid hedge against inflation. John chose to invest in the stock market. Jane suggested investing in real estate, which can provide rental income and appreciation. After a year, they met again to see how their investments had fared. Each had different results. Jack earned $200 in interest, and his savings were now worth $200. Jill had bought gold, which had increased in value by 5%, so her savings were now worth $10,500. John had invested in the stock market, which had given him a 10% return, so his savings were now worth $11,000. Jane had bought a property for rent, generating $1,000 in rental income, and had increased the property's value by $2,000, so her savings were now worth $13,000. In this parable, we can see 4 ways to save to beat inflation: savings accounts, metals like gold, the stock market, and real estate. Each option has its pros and cons, and it depends on you to decide which one is right for you based on your goals, risk tolerance, and financial situation. Numbers that speak. Statistics behind saving and investment. Now let's take a look at some statistics that support this parable. According to the Federal Deposit Insurance Corporation, the average interest rate on savings accounts in the United States is 0.37% as of March 20th, 2023. This means that if you have $10,000 in savings, you would earn $37 in interest over the course of the year. In contrast, gold has historically been a strong hedge against inflation, with an average annual return of 7.78% since 1971. The stock market has also been a solid long-term investment, with an average annual return of 10% for nearly the past century. Real estate investment has provided an average annual return of 11.6% in the last decade. Savings account. Safe but inefficient. A savings account is a conservative option for saving money, but not for investing it. It has the advantage of being safe and liquid, meaning the money is protected and available at any time. However, it has the disadvantage of offering a much lower return than inflation. For example, in the United States, the annual inflation rate was 3.0% in June 2023, while the average savings account interest rate was 0.37%. This implies that money in a savings account lost 2.63% of its real value in 1 year. Metals, gold, a hedge against inflation. Gold has natural scarcity and sustained demand, making its value stable and resistant to currency fluctuations. It is considered a safe haven investment against inflation. Its value does not depend on any government or currency, but is determined by supply and demand in the international market. Gold has a direct relationship with inflation, meaning that when inflation rises, gold also rises, and vice versa. Between the years 2000 and 2010, the U.S. economy experienced a cumulative inflation of approximately 27%. This means that, on average, prices of goods and services in the United States increased by 27% during that period. As for gold, in the year 2000, the average price of gold was $279.29 per ounce. By the year 2010, the price of gold had risen to $1,410.25 per ounce. If you divide $1,410.25 by $279.29, you get a multiplication factor of approximately 5.05. This means that during that 10-year period, the price of gold multiplied by over 5 times. Stock market, higher risk, higher return. The stock market is an investment option that offers the potential for exponential capital growth in the long term. However, it also requires a high risk tolerance since stock values can fluctuate dramatically based on supply and demand as well as external factors. For example, the S&P 500 index, representing the 500 largest companies in the United States, had an average annual return of 13.6% between 2010 and 2020, but it also experienced drops of 37% in 2008 and 34% in 2020. Real estate, income and appreciation. Real estate investment involves buying or building real estate properties with the aim of earning periodic income through renting or selling them. Additionally, real estate properties tend to increase in value over time, resulting in capital gains upon sale. According to available data in the European Union, from 2010 to the fourth quarter of 2021, housing prices for sale increased by 42%, and worldwide Airbnb revenues approached approximately $8.4 billion in 2022. This represented not only an increase of about $2.4 billion compared to the previous year. Keep in mind that there are many more ways to save your money. Remember to evaluate the inflation rate in your country and compare it with the returns offered by the savings and investment options you are considering to make informed decisions on how to protect your savings and beat inflation. Thank you for your attention. If you liked the video, please help us by subscribing so we can bring you more content.